Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another exciting episode of the What Matters podcast, where we dive into conversations that truly matter. I'm Mike Mershazadeh.
And I'm Ashley Ward.
Today, we're thrilled to have David Sather, CEO of Sather Financial Group Incorporated, joining us. Sather Financial is a fee-only strategic planning and investment management firm overseeing approximately $1.8 billion in AUM. The firm is ranked as one of the top wealth management firms in the nation.
Dave's commitment to financial education and his passion for helping others achieve their financial goals truly shines through his work. He's here today to share his insights with us and our listeners. Welcome to the show, Dave.
Thank you so much for the invitation.
Well, it's fantastic to have you with us. We're excited to explore some exciting topics. So let's start by just diving right into your journey, Dave. So can you share with us and our listeners a little bit about your background and the experiences that really led you to now being the CEO of Sather Financial Group?
Well, I can tell you that it's been a very long journey. I've been running our firm for 25 years, but started with very, very modest beginnings. So I was a broker with Payne Weber, which is now part of UBS. And Mike, you and I were talking before we got started about cold calling. In my first probably 9 months, I cold called everybody in the phone book in the Victoria, Texas area. And at the end of that, I realized that if I was going to live in a rural community, I was going to have to develop business some other way than cold calling. You just don't develop relationships in a rural community just by cold calling strangers. And so I stuck that out for about 3.5 years. After that time, the oldest bank trust department in Texas was looking for somebody to manage their trust investment department as well as to begin their brokerage operation. And so at the ripe age of 28 years old, they hired me to do that. And it was a very fast-paced time. That was 1996, 95, 96. The markets were booming. Everybody was making money. It was a lot of fun. And it really helped to cement my feet in Victoria, Texas, as somebody who could work with very high net worth people, help them get from point A to point B. But then in late 99, I went to my bosses and I said, right now we're catering to the investment side. And I've never met a wealthy person who only has investment needs. They have tax planning needs, they have estate planning needs, retirement, large asset acquisition, a variety of other things. And I said, if we're not serving these things, one of these days this wonderful bull market is going to turn. And our clients are going to sit down with us, have a very awkward conversation, which they say, so I gave you $1 million, I've lost 100,000, and I paid you 10 grand for the privilege. Where's the value add? And so my pitch to them was that we really need to develop a holistic wealth management firm, not only the investment side, but the other things that really add value. And I told them, I said, you can either do it because it's the right business strategy or recognize that if we're not doing this, somebody else is going to come into the market and help our clients to achieve these goals. And in the process, they will weaken the relationship we've got with them. For whatever reason, they didn't want to pursue that. That opened the door for me to leave in April of 1999. If you'll remember, tech, internet, and telecom was just rolling big time back then.
Yeah.
And I was steady writing articles that were very much of the Warren Buffett mindset of saying, just because the internet's going to change the way we live does not mean that it's going to be a good investment. And I looked very much like, an odd bird because I wasn't, crowing on whatever tech stock was going up 20% that day or that week. And of course, in March of 2000, that's when the NASDAQ peaked. And then all of a sudden, value investing seemed like it was a pretty darn good thing. And so for that next decade, 2000 to 2009, especially like of the foundations where we track their performance every single month, we earned about an average of 8% a year during that next decade. And that was the decade where Yeah, the S&P 500 went zero. And when you start thinking about managing money for real people that are trying to live out of their portfolios in retirement, or foundations, like we work for a children's home. If we blew their portfolio up during that time frame, kids literally would have been on the street. No food, no clothing, no education, nothing. And so it really helped us to understand just how critically important managing investments and helping clients to meet the other goals really were. And that's where the strategic planning really started to take hold. With this children's home, for instance, we help them with their annual budget. We help them with assessing pay raises. We help them buy vehicles. We help them hire contractors to build cottages for their kids. We help them with aptitude testing for the children that live there, and then ultimately get on to college or trade school. So that's kind of how things started. When I first left the bank to start my own firm in '99, I thought, if I could just get $10 million in assets under management, I'd make about as much as I was at the bank. And we got that in the first 6 months and just never looked back.
So let me ask you this, highlighting on that, right? Do you think that this AI sector right now, would you compare that to what the tech boom was?
I think there's some similarities, but there's also some pretty distinct differences. Back in '99 and 2000, you had conceptual investments, meaning that, there were people that were pitching ideas that had no earnings and in many cases no sales. Whereas Adobe or Microsoft or Google, they are going to harness AI and implement it to make their operations better. And so this is already a business model that exists. It's super capital light. They make phenomenal amounts of money. We openly joke that even if we wanted to fire Microsoft, we can't, because they add so much value to our day-to-day operations with the Office products. And certainly in the middle of the pandemic, we learned how valuable Teams was. So if you're then adding AI onto what Microsoft already does, it's probably just going to enhance how well we use technology, as opposed to it being this complete startup and we're not sure whether or not it's really going to take hold.
Yeah, I totally agree with you. It's like it's like those those penny stocks, and you take a look at them, and I remember during COVID, there were these companies. It was like this diabetes product for cats, and right, and it had a $4 billion valuation. And I remember Kathy Woods was like promoting this thing, and I remember like my friends telling me, "Oh yeah, man, I heard you should buy this stock." And I was like, "Who told you?" And then one of the guys like, "Well, my Uber driver was talking about it." And I was like, "Well, then why isn't he trading the stock, right? Why is he,
Right.
why is he picking you up in the morning? But to the point there, right? It was a company that had like a $4.4 billion valuation, and they projected that their earnings were going to be at like 80 million in 5 years, right?
Yeah.
So, yeah.
Lots of interesting projections, and they're just that. They're projections.
Yeah.
However, and again, going back to managing money for real people as opposed to a theoretical benchmark or things like that. I mean, if we blow people up, there are real consequences. And, I always tell our clients, when it comes to gambling on different stuff, I'd rather them go to Las Vegas and enjoy a good show before they give away their money. With us, I would rather them own some stuff that I know it may be bumpy along the way, but they're going to make good money over a decade or, an economic cycle. Because again, especially with retirees, once they're out of the workforce, say 18 months, maybe 3 years, there's no chance of them coming back into the workforce. Their skill set grows tired, and all their contacts have moved on. So retirement planning and the management of investments for retirees or for a foundation, whatever the case may be, it's kind of a one and done type shot. If you blow them up, the ability to recover is extremely difficult.
Right. And more than likely they're at that age where, they may not have the energy to go and recover it.
Right.
And so, speaking of that there's actual cash earnings there in the AI space, let's talk about for a hot second, the crypto space, right? At least for myself, I don't know anybody using digital currency. And so, these companies, they have some of them have a pretty outrageous valuations to them, and yet nobody's using them yet. So what are your thoughts on that?
I have a variety of thoughts, and none of them are conclusive. So, to me, I think crypto has some legs because everybody's so frustrated with the federal government because they keep devaluating the dollar. And, it used to be the old saying was there's only two things that are certain in life, death and taxes. Well, I would add on a third, death, taxes, and devaluation of the dollar. I mean, the dollar since the Federal Reserve came into existence in 1913 has lost about 97.5% of its original value. And yet we still use it as currency, but it does make the point that it is a currency that will lose purchasing power over time. So to me, it's not the craziest thought to think that somebody would want to come up with an alternative currency or a measure of trading value back and forth. But as far as a currency goes, Bitcoin and Ethereum and all of those, they're extremely volatile. So to me, it doesn't really pass that test as a currency. I also don't know who really stands behind it other than a whole bunch of people who say, yeah, this is awesome. It's awesome as long as it's going up. And they start to become a little weak-kneed in a challenging market. Again, we've got some clients that have dabbled in it, like play money, but nobody who is seriously taking it on. We always explain to them, we own good businesses to offset the devaluation of the dollar. That is a much more sane and rational way of maintaining and building purchasing power over long periods of time. But we use cash, which is denominated in whatever your local currency is, to pay our bills that are due in the next 30 days. So for us in the US, that's the US dollar. If you live in Switzerland, it might be something different. But for most of us, crypto and Bitcoin and things like that, it's much more of a theoretical exercise or maybe just a gamble.
Yeah. And so let's talk about Sather. You guys have grown the AUM. You said you started off, you had this is almost a quarter century ago, right?
Right.
And you guys, you're like, man, if I could just get 10 million in assets, that'd be amazing. You guys eclipsed that in 6 months, and now sitting there close to 2 billion, if I'm not mistaken. We get our information from the public domain there, Discovery. So a membership domain, I should say. But what got you guys there? Did you do it through organic growth, inorganic growth? Tell us a little bit about that.
Yeah. So that is really part of what makes our firm, I think, very unusual. Number one, we're in a rural community. So Victoria, Texas is like 60,000 people. So we're 2 hours from Houston, 2 hours from Austin, 2 hours from San Antonio. Life moves at a different pace in a rural community in the South, number one. Number two, I've just always had the mindset that if you take good care of people, good things will happen. May not happen on your time frame, but it'll happen. And so as we've grown and we've brought on young people, a lot of times they'll sit there and they'll say, well, where did this account come from? And I'll start recounting the number of relationships it took to get there and when that seed was planted. And pretty much our math formula is that business we get today was based on a seed that was planted 10 or more years ago. So it's a very, very long gestation period. But we're actually at 1.9 billion right now. That's a pretty sizable RIA, especially in a rural community. And I think a lot of that just comes from answering the phone, speaking in plain English, being able to manage money, meaning that we are the ones doing the investment work. So we do not outsource any of that. All of the investment work is done in-house. So if we put Union Pacific Railroad or Lockheed Martin in a portfolio, it's because of work we did. And we know the thesis behind it. And we can explain that to clients as that this is why it's in your portfolio and this is how it's going to help you get from point A to point B sometime in the future. That consistency of communicating in a clear and concise manner over and over and over, I think really has been one of the differentiators. 2008, 2009 was one of my worst moments for obvious reasons, very challenging, but it was also one of the best moments in the firm. During that time period, we lost 3 clients. 3 of them just said, peace out, I'm done. And 3 went to cash. Every other client stayed with us. So, you think about how hard that time frame was. That's because we were on the phone walking them through, this is what your investments are actually doing. Turn off Fox News, turn off CNBC. Let's just talk about the businesses that you own and how they're going to help you accomplish your goals. And that allowed them to calm down, turn off the news, go play golf or something like that would add value to their lives. And I think that word of mouth, that we actually do return phone calls within 24 hours, if not much quicker. There is no communication of any sort that goes 24 hours without being returned. And then just being able to explain to people how and why we build portfolios and how that's going to help them achieve their goals.
Yeah, you guys are true, not stock pickers. You're true wealth planners.
Yes.
So that's awesome. And let me ask you this: in total, how many advisors do you guys have now, and how many total teammates?
So there are 10 of us right now, and there are. I'll be careful about how I say this, because there is the quote unquote admin team, and there's 3 there. But I think anybody who is very honest about the quality of their firm recognizes that all customer service starts with your admin team. So they may not be quote unquote financial advisors, but I guarantee you they're the ones who pick up the phone and they're the ones that solve problems. So there's 3 on the admin side. Then there's another 3 that are facing clients, CFPs, CPAs, and then there's 4 more that do analysis, and they will have the ability to grow into client-facing positions also.
Great, thank you.
And so, Dave, let me ask you this. Along the way, what do you feel are some of the most valuable lessons that you've learned in your career as a financial planner, as a CEO? What advice would you give to aspiring financial advisors looking to carve their path in the industry?
I appreciate that question. I think I've thought about that a lot in the last year. Our firm celebrated its 25th anniversary, and that also meant that I've been in the business for 30 years. And when you are building a business, there is no such thing as your business. There is the team that you build. And so hiring really good people is critically important, especially younger people. I tell them about the 2 a.m. rule. And they're like, well, what does that mean? I said, we've got this client. Her name is June, and she is a tough widow who has survived the oil field. And she will drink you under the table, and she will cuss you up one side and down the other. But if she calls you at 2 a.m. and says, I need something, the litmus test is, do you come up with a bunch of excuses, or do you get up and go? And I said, so the people that have hired us, they're not just hiring us to manage their money. They're hiring us to take care of their families. And you learn who's really in the trenches with you at 2 a.m. when they need a ride, when somebody has died, when somebody's had a stroke, something really bad has happened. And that's when you really figure out who is on your team for the right reasons. And we've had a lot of people that have come and gone from our firm because it just wasn't the right fit. So finding those right teammates who truly have it in their heart that no matter what's going to happen, I am here to take care of you. That is critically important. I also think, too, that you've got to pay your people decently. So again, going back to the admin team, after 0809, we set up a profit sharing plan. It's not a non-qualified. It's more after paying all the bills, we set aside 7% of the profits, and that gets divided amongst everybody in the firm. Because the last thing in the world I want is for somebody who's a producer to bring in a whole bunch of new business. They dump it on the admin's lap and say, go take care of all this paperwork. If they don't have a reason to see success in that, they're going to resent it. And so everybody who's been with our firm 1 year or more participates in profit sharing. I don't care if they're the janitor or the mailroom person or whatever their title is, everybody participates in that. And we also do peer evaluations. So the profit sharing is 25% how long they've been with the firm, and then 75% peer evaluation. Because as the firm has gotten larger, I have less understanding of what's going on in all the nooks and crannies of the business. I want to have that feedback back to me as to what's working, what's not working, who can improve, how they can improve, and things of that nature. And so hiring really good people is just key, incentivizing them, and then paying them fairly. I have often said that if I am the only one that walks away from this endeavor with, fair number of nickels, I'm going to be mad at all of them. I want everybody to have a seat at the table and to participate in our success, because the other thing that is very obvious, you don't get to $1.9 billion without working some long hours and being pretty bright at what you do. I want them to be happy that they are coming to work. I want them to be very collegial and work well in a team. When clients call, I don't want it to be a drudge of, oh my God, it's this one again. I want it to be, Sather Financial, how can I help you? I want them to exist for the sole purpose of taking care of others. And if you kind of start with that culture, that helps to really build the foundation going forward. It also helped that early on, I was introduced to who Warren Buffett is. And so very early on, I had my MBA, but it was all efficient market theory type stuff that they taught in graduate school back then. And then funny story, this guy said, oh, so you're going to go off to New York to do training, huh? And he says, you don't need any of that fancy book learning. And I said, okay. He goes, I'll tell you everything you need to know about the investment business in one sentence. And I just stopped, and I was like 25, 26 years old at the time, so I didn't know anything. He just goes, eat them, drink them, smoke them, go to the doctor, and look good when you get there. And I just stopped, and he goes, I can tell you're a little bit slow, so I'm going to repeat myself. Eat them, your food companies. Drink them, your beverage companies. Smoke them. He goes, I don't smoke, but if other people want to, I'll invest in it. Go to the doctor, your healthcare related companies. And then he stopped, and he goes, you're engaged, aren't you? And I said, yes, sir. And he goes, I'm going to tell you something about your fiance that you don't know, but you need to know. She will allow the house to burn down around her before she goes out in public without her hair and nails being done. So my last category for you is cosmetics and beauty supply. And he goes, if you'll invest in those types of companies, you're never going to be the rock star at the cocktail party with the latest, greatest thing, but you're not going to blow people up either. And at the time, I just kind of laughed about it, but it was obviously a pretty funny saying. I've remembered it all these years later. But then I started reading about Warren Buffett being the largest shareholder in Coca-Cola and buying all of Dairy Queen. So many of the themes in Buffett's portfolio at Berkshire Hathaway very much resonated with eat them, drink them, smoke them, go to the doctor type things. That helped us to navigate 2000, 2001. It helped us to navigate 08, 09. It helped us to navigate the pandemic and just continue to grow. During every downturn, we came back out the other side stronger with our clients in a better position to really survive and thrive.
Really cool. And so your advisors, did you home grow them, or did you hire out of the wirehouses?
So the first hire had zero investment background. He was my phone guy. This was in the early 2000s, and the phone company was trying to transfer him to Houston. His wife was pregnant with their child, and they didn't want to go to Houston. And so he's like, yeah, I really don't know anything about the investment world, but if you'll give me a shot, I'd really like, to stay here. And I was like, man, I need some help. So he was like employee number 2. And today he's the president of the firm. He's a CFP. He's by far the smartest person I personally know. I just got really, really lucky with getting somebody that qualified. But from there, we ended up developing an educational program called Bulldog Investment Company at my alma mater, Texas Lutheran University. And the original inception of that was to teach kids how to read and interpret financial statements, do some valuation work, and research companies the way that Warren Buffett does. And so that program has now finished its 15th year. It was recently recognized as the top student-led business program by the Accreditation Council for Business Schools out of more than 1,200 schools. So I'm obviously pretty proud of it. It's also been a wonderful training ground to hire people. So when you look at our investment team, they are all graduates of that program. So they are all homegrown.
Really cool.
So, Dave, you mentioned the 2 a.m. rule. Leading a successful firm requires more than just hard work. Are there any other ways that you think your team differentiates Sather Financial in this very competitive market that we have? And what are the key strategies to your team's success that has gotten you so far to where you are now?
This is going to seem like not that big of a deal, but at the time it was. So in the 90s and even into the 2000s, the thought of being fee only and fiduciary, that was very unusual. When I set up shop in Victoria, there was only one other RIA. However, I had worked, for one of the big wirehouses. I had worked at a broker dealer that resided at a bank, and I ran a bank's trust department investment program. So I had a couple interesting vantage points to be able to see how the business worked. And, Buffett had always said, don't do anything you don't want on the front page of the newspaper. And it was very obvious that living in a small community, Victoria may be 60,000, but it acts like it's about 6,000. So if you keep your nose clean for a decade, maybe they'll shrug their shoulders and go, he's not a local, but maybe we'll talk to him. But if you burn somebody, if you cheat somebody, if you steal from somebody, word will spread like wildfire. And so in recognizing that, you can either think that I did it because it was the right thing to do, or you can recognize that being honest and decent is a great business model. And there's so many bad people in respective industries that if you're just honest and you take care of people, it may not happen 1, 2, 3 right in lockstep, but eventually there are great benefits that will happen. So when I left the bank, it was to be a fee-only fiduciary. And a lot of times I found myself having to explain what that actually meant. But I think we really go out of our way to be as transparent as we possibly can. This is what I'm going to charge you. This is how the fee's calculated. If the assets in the relationship grow, we get a pay raise. If the assets shrink, I take a pay cut. It's not a perfect situation, but it's the one I find keeps us more aligned to try and help you with your assets. And so recognizing that opportunity was right in front of me, I can remember in 1999 thinking, it is so obvious this is a superior business model over the wirehouses. I gave myself 3 years. And in 3 years, everybody is going to be converting to this business model. It's taken more than 20 years. They're finally catching up. But I will tell you, in Victoria, Texas, there are still only 2 fee-only RIAs.
Wow.
So stuff that you think would take on and really take care of people has not taken hold the way I would have thought. The other thing too is you've really got to have a long-term time frame. We truly think about where do we want this relationship to be in 10 years or 20 years, not 6 months. We do no annual planning whatsoever. There is one mandate, and that is do what is in the best interest of our clients. If we do that, it's not a math formula, but somehow it ends up working out.
Thank you.
Thank you for sharing that.
And let me ask you this regarding the next 5 to 10 years. What do you see as the future of Sather? Have you guys already started implementing your G2 in the process there, or where do you see yourselves in, let's say 5 to 10 years from now?
Yeah, so a little bit of insight into my personal life. My wife and I don't have any kids, and so internal passing it down is not going to happen. And I actually think that's a blessing, because that makes sure that I don't bring Junior into the fold just because he's my son. So recognizing that, my goal had always been when I turned about 35, I was like, okay, I've got to build this so that I can turn over the ownership to the employees. At 35, I wasn't in a position to do so yet. We were still growing. But the goal was always that at age 50, between age 50 and age 60, there'd be a 10-year plan by which about 50% ownership would be transferred down to the employees. And so I started first by giving an owner financing a 1% ownership piece in the firm to 4 key people. And so that was generation one, I guess, of succession planning. And then in 2021, my 2 key guys, so Warren, who's now the president of the firm, John, who's vice president, they ended up coming to me and they just said, we get to see all the numbers, we see the clients, we see what's going on here. We want to buy in a more meaningful manner. And so they went to an investment bank out in North Carolina. They borrowed a chunk of money. And so Warren now owns 17% of the firm. John owns 16% of the firm. I still retain about 2/3, but I would imagine more of that will continue to get passed down as we continue to grow and try and incentivize people to stay involved for the right reasons.
Oh, cool.
And so, Dave, what do you see as the future of the industry, the future of wealth management? What trends, technology, strategies do you think are really going to shape the future of the industry in the coming years?
Ashley, that's a great question, because if you think about it, technology is deflationary. So when I first started the firm, I had recognized that if I had tried to do so in 1994 instead of 1999, that the cost of technology to be up and running, it would have cost 50 grand. 5 years later, a computer, a printer, a fax machine, some business cards, and a phone, it cost me maybe $3,000. And so you recognize how deflationary technology is, and it allows us to do a lot more heavy lifting. One of the things that we do on a regular basis is ask the question, what do we do now that is better served by outsourcing to somebody who's better equipped to do it? As well as what kind of technology can we implement that allows us to have greater operational leverage? Technology continues to get better and better. Software continues to get better and better that allows us to do a lot more heavy lifting, to where people are talking to our clients. They're not busy crunching numbers all day. And that's even true of our analysts. The Excel models that we're able to build, going back to Mike's question on AI, using AI to be able to run our Excel models to project out where different investments are going, all of that is allowing us to be much, much more efficient. So when we think about Google or Microsoft or Adobe, those are all super capital light businesses. They require zero money. They don't have to go to a bank and borrow $1 billion to build a factory. They spin off so much cash that it's a wonderful high-class problem to have. Similarly, in our business, personnel is the key expense. We spend maybe $250,000 a year in technology, and that's on a high side. So technology never calls in sick. Assuming it's not some sort of an outage, technology generally works really, really well, and you can upgrade very quickly. And so all of that has allowed our firm to stay abnormally small. So again, we're at $1.9 billion and we have 10 people. From what other people in the industry tell us, most firms are double, if not quadruple the size of ours.
Triple.
I
think when you said that, I thought I was like, okay, 10 advisors. That's what I thought, like right away when you said that. And then, then you'd have another 15 people that, doing back end work. Because I'll tell you this, as I said, we've done, close to 100 podcasts, and, we've talked to a lot of firms that they'll be at 2 billion and they have, between 25 and 40 employees.
Yep.
So that's amazing.
I will tell you that part of it is I can't find people that share our mindset. There are a lot of people that come out of the wirehouse and they think that, okay, I'm going to show up at 9, I'm going to make some calls, I'll be done at noon, I'm on the golf course. Maybe we're just gluttons for punishment. Maybe we're just dumb and we haven't figured it out. But we're usually in the office well before, 7:30, and usually I'm having to tell Warren at 6:30 at night, you got to go home. And, we work a lot of hours. We get a lot of leverage out of that. But I think we also love what we do. But always trying to push the envelope in terms of the technology that's available, I think has allowed us to keep our footprint much smaller. And I think we've also been smart in who we hire, who we take on as clients. So just because you've got a lot of money does not necessarily mean that we want you as a client. If you've ever read the book, The Millionaire Next Door, that is who we want as a client. They're probably running a machine shop or a salvage yard or an oil and gas services company. They wear boots and blue jeans. They drive pickup trucks. They are not high consumption lifestyle people. In general, they are hiring us because they want to run their business. They want us to run their money and coordinate that end of it. And they know that they want to delegate that responsibility to somebody else. That is a key issue. We only will work for people who are delegators. If they're wanting to call us multiple times a day to talk about a given trade and what do we think about trading options now, or things of that nature, it just doesn't work for us. And so the people who stay with us that do really well, they leave us alone to do the job. It doesn't mean I don't like hearing from them, but I want to talk to them about their estate plan or the retirement planning, or how do we structure their risk management, stuff that's really value add. The latest day trading strategy, that just slows us down.
Yeah. Fascinating. Dave, so now let's talk about investments. What investments and sectors are you most excited about right now? Where do you see the next wave of wealth creation coming from?
I don't know about a next wave, but it's certainly been fascinating. I wrote a paper not too long ago on how our investment mindset had changed. And I'll tell you that, going back to the 90s, we owned lots of banks and we owned lots of pharmaceuticals. Not because we were smart, because we got lucky. And so we were riding the wave of interest rates coming down with all the big banks. Their credit was much improved coming out of the recession of the early 80s. And so they were all in a greatly improved position. We could kind of see that trend, but I'm not sure we were smart enough to really figure that out. In pharmaceuticals, the regulatory climate from the FDA was way different in the 90s and the early 2000s. Right. We're not smart enough to sit down and look at a biosimilar compound and compare it to a competitor and say why one is better than the other. We recognize that we're not that smart these days. So we got lucky. In the early 2000s, we were buying things like Budweiser and Johnson & Johnson and Procter & Gamble, Berkshire Hathaway. Those were very easy assets to own. We bought, and then after the tech wreck in 2000, 2001, we ended up going into Microsoft. And that was really the beginning of some really wonderful technology type improvements and additions to our portfolios. We were buying Microsoft when it was trading for 11 times earnings, and clients were telling us that nobody would ever use Microsoft products again. Game was over. Apple was going to win. Nobody uses Microsoft. We were buying Microsoft at 11 times earnings, and it was growing 11% a year and had virtually no debt. And we still own it to this day. So what we have seen, though, if you go back to, if you look at every decade, whoever the leaders are, the S&P 500, they are never the leaders for the next decade. There's a lot of competition that is out there. Number two, if you look at a lot of the leadership coming out of World War II, it was General Motors, it was Ford, it was Chrysler, it was GM, it was the airline manufacturers. It was very capital intensive, and the United States had the ability to distribute that stuff all throughout the world. But it was all very capital intensive. You had to borrow a lot of money, and it made it economically cyclical. Coming into the 2000s with the rise of software, and certainly now software as a service, you've got these super capital light businesses that are able to do so much work just because of good software. So Intuit that makes Quicken. We use Quicken here. We used Quicken our first year in operation 25 years ago. We still use Quicken to do all of our bookkeeping here. And so whenever you can see a software program that doesn't cost that much money, but adds that much value to our operation, that's a really good thing. And so as far as where we find things, it never ceases to amaze as to where we find that next slug of value. I think it was probably 2020, we took a position in AutoZone. We had followed it for years, but At that time, everybody was talking about the dominance of electric vehicles. Nobody was ever going to drive an internal combustion engine vehicle again. So everybody that sold services and products for internal combustion engines got thrown to the ditch. And for us, the average car at the time was like 11 years old. You're not going to just stop driving cars and automatically go buy a Tesla. That's a very first world issue. Most people, they have to have their car to get from point A to point B. They've got to keep the brakes going. They've got to keep the radiator full and stuff like that. So we ended up buying AutoZone at like $1,000 a share. It's at $3,000 today for simple reasons, and just looking for those opportunities where there's a mismatch, where everybody falls in love with a given sector and they all go in one direction. We're looking over here. Similarly, Lockheed Martin was another one of those. To us, at the time, we were getting along with Putin. But when we took that position, here's the largest tier one defense contractor in the world, and they were trading at a generational low. You don't have to study too much history to know that peace does not last too long. Peace is a very elusive thing also. And so when we talked about it, owning Lockheed Martin is like having the biggest, baddest, meanest pit bull on the front porch. Having a good defense contractor, having F-35s, having missile systems, having those defense systems is like having a big pit bull on the front porch. It keeps bad players at arm's length. And so we ended up buying it. It went, and then Russia invaded Ukraine, and then Israel and Gaza happened. And all of a sudden the stock went from trading at a discount to trading at a great premium. So we have since sold out of that. As far as where we go from here, not much is trading cheap right now. We find that technology companies continue to be delivering better growth, but they're also priced as if they're delivering that growth. I'll throw one out there, Paycom, which competes with ADP and Paychex, so payroll processing and human resource benefits, things of that nature. Depending on what day of the week it is, we're all concerned about we're going into a recession. Recessions typically lead to layoffs. We know interest rates went up to try and slow corporate growth down. Paycom sold off hugely. In our opinion, it's a great software as a service type business. It allows people to do a lot of heavy lifting without much capital outlay. That's the kind of thing that we are looking for. Paycom also return on equity and return on capital well above 15% on a consistent basis, and they have no debt. In fact, they actually have negative debt. They have extra cash on the balance sheet. You find a company like that that is run by the founder who still is incredibly engaged. Those are wonderful check marks to sit here and go, you give them enough time, that's going to be a really good investment.
Do you think Paycom's still a good buy?
Yeah. Yeah, it was at like 163 earlier. We've been buying it anywhere between 170 all the way down to 140.
Thank you. I just took notes on that one. And you know, let me ask you this. And so when you take a look at, let's say, there's lots of companies, well, not lots, but I'd say, companies like, Meta, right? That, is obviously, quadrupled in value over the last couple of years. From, it was up, and then it went all the way down to around, I think, $100 a share, and now it's trading at an all-time high. When you take a look at a company like Meta, that's gone up, and there's Nvidia, things like that. But then there's lots of other tech companies that haven't gone up, right? For example, things like Snapchat and companies that have still been repressed from the pandemic. Even things like Lyft, Uber, things like that. What do you see happening with the rest of that tech sector? Do you think that they're going to follow suit, or do you think that they were just never strong enough to get there to begin with?
It is pretty funny to watch who ends up being the winner, because you bring up Meta or Facebook. Think about who the original winner was. It was MySpace. And, like with Uber and Lyft, I mean, who ends up winning that? I don't know. For us, like with Meta and Alphabet, they're advertising platforms. And so recognizing they are just advertising, It's just a matter of how you end up engaging with people. To us, that's a different platform. There's lots of reasons to engage in those. Whereas as generations move on, Snap is no longer the cool thing, or maybe it just wasn't big enough to gain that scale. For whatever reason, that the value is not there the way it is in others. And so it's fun to look at them because it's fun to look at the entire industry. I don't have to own all of them. I just need to find the one that's right. And so we have owned Meta in the past. We do own Google currently, again, for those exact reasons.
Thank you. And so, my last question to you is, taking a look at what's happened over the last, few years here, we've seen interest, the 10-year treasury, for one, going from 0.6, 0.7, all the way up to close to 5%. And it's been teetering between that 4 and 5% range. Personally, in my opinion, I think it's going to stay there for a while. But I want to know what your opinion, what your outlook is on the economy. Where do you think interest rates go? Despite who's going to be the president, where do you see interest rates go, and where do what do you see happening there to the economy, over the next few years?
Yeah, Mike, that is probably the favorite question that all of our clients want to discuss for a variety of reasons, because they just want to understand the world around them. But in 22, there was a pretty good pullback in stocks. But when you looked at like payrolls and when you looked at employment, there was not an indication of a huge recession. And again, I'm not going to pick on Jamie Dimon, but people like Jamie Dimon are highly respected. We're saying there is an economic hurricane on the horizon. That's enough to get your attention. Yeah. But it never happened. But we had that big pullback. But throughout all of it, unemployment has continued to be very strong. And at the same time, inflation has continued to come down. So it was 2 years ago that inflation was 9.1%. And today we're in the low threes. Wage growth is continuing at about 4%. We've now had 14 months in a row of real wage growth, and yet inflation continues to moderate. And so for us, with an economy that's 70% consumer spending, GDP is 70% is consumer spending. If people have jobs, they will spend money. People don't have jobs, they don't spend. And so we pay very close attention to payroll and employment numbers. You've also seen companies right size. So if you look at the job openings number, at the peak, it was 12 million. It's now fallen all the way down to 8 million. So basically, that has taken a lot of that excess desire for employment off the market without having to fire anybody. So it did this magic trick of lowering inflation, because now companies aren't all out there competing for Mike's services. Instead of there being 10 companies wanting to hire you, now there's probably 2 or 3 companies that are trying to hire you. And that lowers the inflation on the wage front, but yet we still have full employment. When you see that combination, we still have a really good economy. It doesn't take away from the concerns about the national debt. If we are successful in bringing inflation down, and now the Federal Reserve is starting to indicate that they see inflation declining also, that will probably lead to cuts in the short-term Fed funds rate. That should lead to a lowering of the interest that the federal government pays on the national debt, and hopefully it will take some burden off of that, and then we can continue to keep growing.
Now, do you think that the reason why, we've avoided an economy and Americans have been able to continue to spend is because, over the course of what it was, 2020, well, I'd say 2019 even, but let's call it, during that whole pandemic, that 1.5 years, where you could get a mortgage interest rate for, the mid to high twos, you have homeowners that they're not going to leave that, right? They got a great mortgage payment. If you take a look at what you buy $1 million house for right now, what your payment would be, as opposed to, what a $1 million payment was a couple of years ago. I mean, it's north of 2x. And so essentially, do you feel like people have that excess money to spend every month, and they're able to put that back in the economy?
Yeah, that is a great question because you're right. A lot of people have very low cost mortgages. And if you look at the people who have financial assets, so brokerage assets or a house, their net worth is at an all time high. If you look at people who have no financial assets, they're really still struggling. So you do have that dichotomy of two different worlds operating in the United States. For the folks that do have assets, they're in a pretty good position. So yes, they may be hesitant to sell their house or maybe trade houses. There's certainly been an imbalance in terms of the amount of inventory that is out there that appears to be modifying a little bit. There's more houses that are out on the market now with rates coming up. Mortgages, we helped a client price a mortgage yesterday at like 6.8%. That's a big difference from 2%. So I do think there's probably a pull forward in a lot of that demand, whether it be vehicles or mortgages or things like that. And now people are kind of sitting tight and going, man, I really don't want to give up that 275 mortgage. So I do agree with you that that has caused some of those financed markets to maybe take a different turn that they traditionally would have.
Yeah, do you think that eventually that's going to really hurt the housing market?
I don't know. I think it already has to some extent. I mean, because it's really slowed down a lot in the last 18 months. I think at this point, it's probably more a matter of people figuring out what can I afford. In time, that will end up running its course. People are going to move, people die, people, are going to trade up or trade down. Those things will work out. But getting back to some of those long-term trends, the pandemic and the stimulus associated with it was so fast. I mean, it was the ultimate shock to the heart. The next 4, 5, 6, 7 years will probably right size a lot of those issues that we're seeing today. It just takes a little bit of time.
Yeah. Thank you. I appreciate that.
We'll see if I'm
I
right.
think that wraps up our questions today, Dave. Thank you so much for joining us on the podcast and sharing your insights with us and our listeners. We really appreciate your time today. It's been great having you.
Thank you. It was a lot of fun to be with you. It's always fun to have really knowledgeable people to have a discussion with.
And to our listeners, thank you for tuning in to another episode of the What Matters podcast. Until next time, stay curious and stay informed. Thanks, everyone. Have a great day.